There's certain things that are crucial when you're talking about risk. We start with your asset allocation, how much stock, how much bonds, how much cash, how much gold, how much whatever. You have to dial that in, and it's not about checking the box. You know, a lot of the investment firms will give you a piece of paper, or they'll give a client a piece of paper that says, check the box. Are you low risk, medium risk, or high risk? That's kind of meaningless. I'll always go and say, if a client goes 50% stock, and that's $1 million towards stock, I just say, hey, here's what happened in the past. The stock market goes down 50% once in a while, maybe 8 or 9 times in the last 100 years. And if that happens to you now, can you handle losing $500,000? I try to put it into real numbers for a client so they can try to get a feel. You can't until it happens, but at least you can start to think about, how would I feel if I lost X amount? Because you're going to go through those markets, ups and downs. And if you don't know going in what the potential downside is, you will make mistakes. From any investment perspective, you have to look at the price you're paying. To me, that's kind of risk number one. Don't pay too high of a price. And the second biggest risk is debt. Debt is what gets a lot of companies in trouble. It gets a lot of people in trouble. It gets countries in trouble. Those are a handful of risks. There's accounting risk. Can you believe that the company's stated numbers are legitimate? A risk that most people don't even think about is that they didn't do the math, they didn't do their homework. You worry about the stock market crashing, that is a risk. But you don't worry that you haven't saved enough, you haven't done the math. You might worry about it, but you've done nothing to check. So to us, that's a huge risk. You need to do the math. You need to look and see, what is your spending? What is your saving? Is it going to be enough? When do you think you want to retire? That's as big a risk, if not more, than the stock market risk. I don't know who said it, but it's a very wise statement that the best way to get out of a problem is not to get yourself in it in the first place. And planning comes into play there. Not planning is a risk that you don't have to take. It's an avoidable risk. There's a lot of risks that you can't avoid. Yeah, we got to deal with those, but you don't have to deal with some. And those are the ones that we try to really make sure that our clients aren't exposed to. You don't have to buy a stock that's price is ridiculously high relative to its profits. You might want to because everybody's having fun with it this year and it keeps going up. But we've seen that story before. It happens over and over and over. You don't know when it's going to end, but it always ends. So there's avoidable risks that we just think are foolish to take. We use all these different risk control methods layered on top of each other to do the best we can. It's not going to stop risk from happening. It's not going to prevent a client from having a bad day, but that's pretty crucial in our eyes.